Over to our man Teddy Kekstadt. You can reach Teddy every trading day at his website, forex-trading-unlock.com. We talk to Teddy every Wednesday at 40 past the hour. We're talking Forex. Teddy Kekstadt, good morning.
Good morning, Tommy.
How we doing this morning, man? What are we looking at in the market of Forex? I know we have some action. We got crude hanging tough around $75. Always think of you in that crude market with the strength it's had recently, man. But what do we got going on in the Forex market for our weekly update this week?
Well, I'll tell you what, choppy is what's going on in the Forex market. I mean, it's basically a tug of war between bulls and bears, but yet the dollar bulls are actually kind of winning, even though it doesn't look like it today. But you know how we've been talking about divergence? It's definitely proven now since we talked last week. If you look at the euro, okay, it made a newer move low yesterday versus the dollar. The dollar was strong yesterday. It was very, very strong. Then it reversed gears overnight. Now, obviously, we have a little bit of a recoil with these other, basically all of the different cross rates versus the dollar. Everything is stronger, okay? But if you look at what's happened, though, as far as look at Europe, you have the euro that yesterday made a newer move low after coming off of a lower move high. Now you have the British pound, however, that had made a higher move high and now has made a higher move low as of yesterday. So I would key off of the lows, the extremes from yesterday and whatever cross rate you're looking at, because that's where our threshold is, because the trend actually relies with those points, meaning that if the euro is up today and all of a sudden it reverses gears and takes out the low from yesterday, that's very bearish. I mean, the trend still is in place, okay? So that's definitely confirmed on what's going on right now in all the cross rates. But we have the divergence, meaning that while the euro-US dollar is a bear, obviously, in trend, the British pound-US dollar is actually becoming in a recoiling short bull trend. Now, I'm looking at that as more of a correction right now. So meaning that on any given day, for instance, both the euro and the pound are up today. But the euro is coming up off of new lows. The pound's coming up off of higher move lows. See what I'm saying? So they're not really trending overall together as far as strength, meaning the euro is weak and the pound is actually holding up. It's kind of what we're seeing with Australia and New Zealand dollar, where Australian dollar is in the same case. We talked about, besides the fundamental economic things and political things going on there, that these repercussions are that there's a bear trend in place in that one, whereas not so much in New Zealand dollar. So where on any given day they may coincide with each other. Like yesterday, they were falling to the dollar, but the New Zealand dollar is doing like the pound. It's coming off of a higher move high, and now it's at a higher move low versus the Australian dollars like the euro. So I think that's something that your FX traders really need to be mindful of right now. That's where, remember how we said divergence is in play, so don't just watch the dollar index as your major indicator right now. And the biggest thing is the bonds and the 10-year, which you were talking about the 10-year earlier. So one last thing with that is that they're coming off of higher move highs. Yesterday, they stamped a higher move low. If the 10-year and the 30-year reverse gears and take out the lows from yesterday, that means the bond traders are really skittish on inflation, and that's what everyone's watching right now.
Yeah, it will be interesting. And I was just going to add, as you pull it up, pretty defined, like you talk about, I look at a lot of equities or maybe just looking at the equity indices in terms of futures, but lower lows and lower highs, like you talk about, man, pretty well defined on some of those charts you're talking about. I like to see that on trends myself. We all know that the markets trade with variance. They trade within trading zones or whatever it is. But when you're seeing lower lows and lower highs as that trend continues, that's something I like to look for, or higher highs and higher lows, right? On the flip side of that, vice versa.
Right.
Yeah.
Right. Absolutely.
Now, of course, we have Chairman Powell. He's out here today and tomorrow. I think he's front of the Senate tomorrow. His remarks already out there, pretty strong in terms of what he's talking about. We're a ways off is how he puts it. And how do you see it, Teddy, that 10-year shaking out, man, in terms of where that drives some of the action? Because it is interesting, of course, the run we got up there to above 134 technically. We had a 10-year yield of 1.25%, I think, briefly on that run, settling back in at about 1.35. I was talking to Kevin Hincks to kick off the program at 9:15 and just kind of talking about he's kind of giving himself some room here to status quo it, at least for a few months maybe, where he's already seeding the fact that prices are going to be hot for the coming months, right? But then he expects things to change. Interesting to see how that plays out in light of basically he's saying, the data is going to say it's going to be hot for the coming months. We kind of all know that, right? And where we are after that period is what he's looking for some evidence maybe.
Well, my whole take on what's going on right now is I look at Chairman Powell and the Fed as how the National Association of Realtors was from 2005 until 2008, and they were saying, "Don't worry, the real estate market's fine," while it was tanking. So the Fed's view on inflation is complete just denial. It's not denial; it's just propaganda. And bond traders are watching that. So like today we have the oil numbers. Tomorrow we have the unemployment claims. Let me tell you something. If that number doesn't come in a positive light, meaning that we're going to hold the bond market in check, if it does look inflationary or bad for the economy, we are going to see new lows trading in the Treasury bond and 30-year and the 10-year note. So it doesn't matter what the Fed says. The bond market sees inflation. And see, the thing is, the Fed is looking at lagging numbers. So it's really easy for them to say in their forecasting that, oh, this isn't going to be so bad. However, when we're talking about having this conversation 6 months from now, right before Christmas, and unemployment is still where it's at, and inflation has not gone down or leveled off, what is the speed going to be then? That means that everything they're saying now is they're not being proactive. They're actually just being in denial, that's what the real estate industry does. They're taking the used car approach of saying, oh, the market's never bad. It's always a good time to buy. Well, it's not. It's just not the case, So I think it's just blah, blah, blah. And I think the bond traders are definitely going to take advantage of everyone that buys into the Fed speak, for sure.
Boy, that's what makes a market great, man. And if we are in 6 months from right now seeing the same type of unemployment, man, it's totally possible too. And listen, I'm with you. I mean, the goal was to turn the key and all the jobs come back, right? And I know that's theoretical, it's rosy, that wasn't exactly how things were going to work, but that's kind of the message of all the stimulus. You keep the keys in the ignition, and that way you turn it back on. That doesn't seem to be the case, at least over the next couple months, man. Let alone, if we're going to get there in the next 6 months. The real worry right now for the Fed pulling back is you're talking about inflation. And yeah, it'll be interesting, and it's coming to roost, as in we're going to find out in 3 or 6 months, because I agree.
And what happens if there's another COVID wave, even slightly? Just slightly. It doesn't.
Listen,
even
we're
have
in
to go into
Florida.
lockdown.
It's a real deal, man. It's a real deal in Florida, I tell you. I'm vaccinated. My family is. I got young kids, though. It's weighing on economic decisions, to put it just bluntly. In terms of bringing out your kids, we're at some pretty harsh levels in Florida, folks, and that's we're back now. My family's vaccinated, but you young kids that can't do it yet is something we're aware of. Am I going to take them to Disney? I don't know just yet, man. We got like 5,000 cases a day among unvaccinated people, so that's going to weigh on things for sure, man. And that's Florida, unfortunately, an anomaly right now in terms of the cases going on, but it matters. But 6 months, man, yeah, if we're seeing those tendencies, but like I said, the benefits end in September, kids go back to school, there's only so many excuses that can be given as to why things aren't happening like they are supposed to be, at least.
Right.
Well, Teddy, I always enjoy the conversation, man. We appreciate the update.
Thanks, Tommy. Me too.
And we'll talk to you next week, man.
Sounds good. You guys have a great week.
You too, Teddy. Take care, man. Folks, check out Teddy's work every trading day, forex-trading-unlock.com. We'll be coming right back to finish up the program.